Yes, this is Byron. I want to talk about options trading. I get a lot of questions about options trading. Okay, I'm just going to show you the basics because a lot of people want to get into investing their money, but not in day trading. They want to invest in options as well. Okay, let's talk about options. Say a stock is probably at, I'm just giving you some examples, $32 a share. I'm giving you some examples. Now, on options, you'll see a format. Say the strike, they got different strike prices. Different prices you want that stock to get to. Say the strike price is at 36, but it's a time frame. You want it to get to 36 in 30 days, and they're gonna charge you maybe like 70 cents or something like that per share. A strike price, one contract is 100 shares. Okay, one contract is 100 shares. Okay, you want that strike price to get to 36. It's probably at 32 right now. This says at 32, trading at $32 a share. Okay, once that stock get to 36, it goes up to 36. Calls, you want the stock to go up. Is at 32, calls, you always want the stock to go up. Say it goes up to 36. Okay, you still haven't made any money because they charge you 70 cent per, 70 cent. They already charge you 70 cents, per 100 shares, one contract. Okay, so you didn't make any money. But say it goes to 37, you only made 30 cent per share because you lost 70 cent per share. See what I'm saying? But if you go up to 38 or up, you make some serious money. It's very easy. Okay, calls. That's how it works. But within 30 days, the contract is up in 30 days. So that's one thing you got to remember. The longer, say you want to keep it for 7 months instead of 1 month. The longer you want to keep the stock, the higher the price is. So it won't be 70 cents per share. It might be like $4 or $5. See what I'm saying? It gets very confusing. Okay, trying to make sure I ain't missed nothing. It's a lot of things. This is about calls. Calls, you always want the stock to go up. Always. Okay, let me erase some of this stuff. You got to write this stuff down because options is very confusing. Like I said, with options, you have to, the longer the term, say instead of 1 month, you want to keep it for 7 months, probably the more expensive is going to be. Say, that's part of calls and puts. Remember, calls is when you want the stock to go up. You want and puts, you want the price to go down. I'm saying like that, not the stock, the price to go down on puts. Calls, you want the price to go up. Puts, you want the price to go down. Okay, remember one contract when it comes to options is 100 shares. You need to write this down. One contract. So some people get 5 contracts. That's 500 shares. One contract is 100 shares. You need to write that down. Okay, like I said, with calls, and remember, you can figure out puts as soon as I show you about calls. Calls, like I said, say the stock is trading at $32. Okay, and you want the strike price, the one contract. You want to buy it in 30 days. It's a time period on all these. You want to buy it in 30 days. You want to buy it at 36. Actually, you're waiting for it to go up to $36. The price of the stock to go up to $36. You still didn't make any money because it costs money. Like you paid 70 cents for the contract, 70 cents per share for the contract. Okay, the contract consists of 30 days. It's different amount of times. You can get it for 15 days, 30 days, 4 months, 7 months. It don't matter. I'm just using 30 days as an example. Okay, say it's the stock is trading at 32. You got you buy the contract. The strike price is at 36. Say it goes up to 37, and they charge you 70 cents to get that particular contract. That's 70 cents per share on that contract. Okay, now you made the strike price is at 36. It went up to 37. Okay, but remember, you still paid that 70 cents. You only made 30 cents a share. That's it, because you lose that 70 cents. But if it goes up higher, and it's not 30 days, it goes up to 39, 40, 41, 42, 43, 44. If it keep on going up, the most you can lose after that 36 is that 70 cents per share. You gain everything else. It's a very delicate and dangerous thing, the options, because you got to know what you're doing. You got to, with calls, you have to expect the stock to go up. If it goes down, you might as well throw away the contract, because think about it. The strike price is at $36 a share. Say it goes down, it's trading at 32, it never leaves 32, it stays at 32. You might as well void that contract because the contract is over with after 30 days, because after 30 days you have to do something. Okay, say it stays at 32. It never goes up to that strike price at 36. Get rid of the contract. The contract is gone. You don't make no money because excuse me. The stock is at 32. Your strike price is at 36. Why buy it at 36 when you could buy it at 32? So the contract is gone and you don't make no money, basically. That's what I'm saying. That's the dangerous part about a call. Okay? Remember, the longer you keep the contract, the more it's going to cost you. The longer you keep the contract, the more it's going to cost you. Okay, and it's something else to remember too. I'll make sure I got it right. I'll make sure I say it right. I want to explain this. Options is very tricky. I'm trying to explain and teach options, the basics of options to people. There's a lot more. There's called covered options, and remember, puts is the opposite of options. Okay, you are the 1 second here. I'll make sure I say it right. With options, when it comes to calls, you are the seller and you selling to the buyer. It's like a handshake. You selling to somebody else. You selling that contract to somebody else. When it comes to puts, you are the buyer and you selling it to the seller. It's like the opposite. I hope I'm saying that right because that gets very confusing even to me. But that don't even matter. The amount of money you make and lose, that's all that matters to me. Okay. Like I said, the longer you keep the contract, the more it's going to cost you. Okay. Oh, this is important. This is very important. Oh, yes. One more thing to remember. The higher the strike price, the cheaper the price is. Say, if the stock is selling at 32, I'm using examples here. The stock is at 32. And instead of at the strike price you want at 36, say it goes up, you want the strike price at 40 instead of 36. Now, it's harder to get to 40 than 36. The lower, remember I said at 70 cents they charge you? It'd be a lot cheaper. But I'm not a lot cheaper, but it'd be cheaper for you because you picked a higher strike price. Options are very confusing. Now, I hope you write some of this stuff down. Now, puts is the opposite. Say the strike price is at 36 and it's trading at 40 in the beginning. And the strike price is at 36. Remember, on puts, you want the stock to go down. Okay, and it goes down to 36 and they charge you 70 cents per share already. You lose money because you're losing that 70 cents. The strike price is trading at 40. The strike price is at 36 and it goes down to 36. You break even. You would think you break even, but no, you still lose that 70 cents. 70 cents times 100 shares. Because remember, one contract is 100 shares. So if you got five, I hate to say if you got five contracts, that's 70 times 500. You lose a lot more money. It's something you got to think about mathematically. So just say the strike price is at 36. It's trading at 40. The strike price is at 36. Say it goes down to 32. And after 30 days, say the contract ends 30 days because you don't have it for 7 months or 2 weeks. Just say 30 days as an example. You can sell. Remember, you can sell contracts at any time. Options contracts you can sell at any time. So say it goes down to 32. The strike price is at 36. It was at 40. The strike price is at 36. And go down to 32. You made a lot of money. You made a lot of money because you made an extra $4 per share because you got it at 36, but it went down to 32. That's $4 more. You made some money on that. If it goes down to 28, you made a lot more money. See, you want that stock to drop drastically when it comes to puts. Now, when it comes to calls, you want it to go up. Remember that. This is the basics of options. I need you to write all this stuff down because you're going to forget it. You need to watch this tape 2 and 3 times. Now, I'm going to talk about covered calls on my next video. Not my next video, but soon. I'm going to talk about futures trading. I'm going to talk about pennies trading, penny stocks. I'm going to talk about swing trades. I do all that stuff, but I don't do it that often. And by the way, I'm looking at my stock right now. Hold on. I'm looking at my stock that I guarantee that might go up Sunday or Monday because the Dow Jones Oh man, what am I doing? Okay, let's see how my stock is doing. Stay with me. Let's see how my stock is doing. KMX. Remember, I hope it's up. I don't know if it's up. The stock market just closed. It's up 20 cents. So it went up today. The Dow Jones closed up 144 points. The NASDAQ closed up 179 points. Here we go. Just to show you. Yep. I hope you can see it there. I got pretty close to my big TV here. But my stock went up again. But it went up. It went down Friday. So because the Dow Jones went down so far. But like I said, if the Dow Jones don't take a stock, if it don't go down substantially, my stock that I pick is always going to go up. So I don't feel bad today because my stock did go up a little bit. But because the Dow Jones didn't go, the Dow Jones controls so much. But that's just a tutorial and a video about options. If you got any comments or any questions at all, please leave it. Send me some comments. Please subscribe to my video. I'm going to talk puts. I'm going to talk about covered, all this other stuff about stock. If you got any questions, want to learn anything about any stock, we could talk about it. I know how to do all stocks. I know a lot of people saying this black man do not know what he's talking about because I'm a black man. But I do. I've been doing it for 25 years. I do day trading. I do options. I do cover calls. I do calls. I do puts. I do futures. I do penny stocks. I do S&P 500. I do so much different things. I do dividend trading. I do ETF trading. I do index fund trading. I do so much, and I know all this stuff. But my main profession is day trading. I'm a professional day trader, and I'm good at it. And I hope you guys believe in me. So I wasn't really wrong on this stock right here, and I usually be right. I'm like 18 out of 19 right when it comes to stocks. Please believe in me. Please give me a chance. If you're not making money in the stock market and you're looking to invest, I'm talking to millionaires. I'm talking to celebrities right now. Whoever watching this video. Please give me a chance because I've been right mostly on all my picks. I'm talking about the movie stars, Gorilla, Denzel Washington. I don't care who's looking at this video. Please give me a chance because I can make money for you and your family. And if you're not in the stock market, it's the greatest form of wealth. Give me a chance because if you don't have nobody picking good stocks for you, you can lose everything. Everything. I mean that. So please give me a chance. I'm going to end this video. In conclusion, I'm going to make another... Well, in conclusion, I'm going to make another video about more stock knowledge. It should be in the top corner up here. But I appreciate you guys so much. I appreciate the views. I appreciate the subscriptions. I appreciate the support. I appreciate everything that everybody's doing for me. Thank you, God. Thank you, God Almighty. Thank you, viewers. Thank you, YouTube, for giving me this platform. I'll see you guys soon. Bam! The Stock Master.